My name's Sean Bruin. I am a financial advisor with Kith & Kin Financial Wellbeing. We are a social enterprise. Fun off my background there made you think I'm probably in an office. I'm stuck in a room down in Newcastle in a wellbeing centre because we are down with the caravan this week. So yeah, we're based up in the NITVA building in Belfast. I've been a financial advisor. Again, my accent might throw people, but I've been over here about 20 years working and living as a financial advisor. I set up Kith & Kin as a community interest company about 4 or 5 years ago. And what we try and do basically is provide people with access to financial advice, because that was one of the reasons we set it up. Was we just noticed that if people had any demand for financial advice, a lot of people just didn't want to turn to financial advisors because they thought they would get charged a lot of money, or it wasn't really for them. So part of the work we do is go into community groups, and we also do it for employers as well. We visit companies and provide financial wellbeing sessions in the workplace. In the good old days, it was face-to-face sessions. A lot of them are done by webinars, but some of them are going back to face-to-face. Now we've done a couple of face-to-face ones recently. So what is a social enterprise? A lot of people hear that word, they're not really sure what it means, but it basically means all the profits legally have to be used for social good, so we basically can't put them in our pocket. That can be used to help us grow and develop, which is what we do, because we're still relatively small and young. From a financial advice point of view, we are salary-based advisors. So, when I worked in different organisations over here in the past, most financial advisors either paid a small basic and the rest is made up of sales and commission, which we felt could influence your decision making. So we wanted to take any of that attraction away, so that we are on a set salary, which means if we give anybody financial advice, it doesn't matter whether they take it or not, we just get paid the same money. And hopefully from an individual's point of view, they're not there sitting thinking, I wonder if this guy's just offering this because he wants to make commission out of it. We're also funded, which is why another reason we don't need to charge for the advice. So we've been funded by the National Lottery, Public Health Agency. Also recently they just get funded by Belfast City Council. So because of all those income streams, it means we don't have to charge anybody for the advice. Most organisations have a variety of wellbeing programmes. Again, another reason we set this up is we noticed that if anybody wanted financial help, there wasn't really any easy place to go. Citizens Advice, we looked at that, but they're not financial advisors, so they can give you leaflets, they can't give you advice. So what we want to do is offer somewhere people can go. It's private and confidential, there's no charge. And also the evidence shows that if you get financial problems, it can lead to physical and mental health issues through lack of sleep and depression and stuff like that. And also the other way around, if you have depression or illnesses, mental health issues, you can then go on to ignoring your finances. So obviously your problems get worse. So we just wanted to provide an option there where we link up everything and provide an option. So we provide access to financial advice. The word access is important there. We do some of it ourselves, and we also signpost to other organisations. I myself, I do mortgages and insurance. I have my colleague Simon who do pensions, savings, investments. For wills and trust, we use a solicitor in Belfast. We also have other organisations like Advice NI who would cover debt, including IVAs and bankruptcies. And again, all the advice from these organisations is all free of charge. One caveat in there is that all the advice is free, but for example, if you speak to your pensions guy and you've got 4 pensions that you want merged into one pension, he'll give you the advice on whether that's a good idea or not. If you then say, yeah, can you go ahead with that, then obviously there's fees involved in doing the work, because there is a lot of work there. Now that will come out of the pension. Nobody at any point will be asked for any money. I know some financial advisors will do both. They'll maybe charge for the advice and then charge for doing the work. So, but that's all the areas that we provide access to financial advice on. Obviously, today is for enterprise NI, so there might be a lot of business owners watching this or listening to this at the recording session. So we've updated some of the slides here. I set up Kith and Kin, as I said, but it is a community interest company, but it's still a limited company. So I've probably went through a lot of the same things as maybe yourselves. And the mortgage advisor as well. So I do come across a lot of business owners who are trying to get a mortgage, and it can be hard for people who run their own business to get a mortgage. Some of the reasons for that is that, depending on the size of the organisation, you might not be employed, you might pay yourself a salary, but what some people do is obviously pay themselves a small salary to avoid tax and stuff, which is great for tax, but it's not good when it comes to a mortgage. Basically, mortgage lenders give you about 5 times your annual income, and if your salary is only 10,000, 5 times that is not enough to get you a house. Now, some lenders will use dividends, but again, that really depends on your accounts. What some people do is they'll make themselves an employee. If you're a limited company, you make yourself an employee, pay yourself a decent salary, and go through that option. However, lenders have maybe cottoned on to that a wee bit as well. So if you are the only person who runs the business, if you apply for a mortgage and they check company's house and see that you're the only director, even though you're an employee, they still deem it as being self-employed because it's a family business. So they'll go back to looking after accounts. So you can use accounts, which is fine. As I said, again, a lot of people we come across with their accounts show very little going through, because lenders look at net profits, they don't look at turnover. So again, if your net profits are only showing 10,000, again, you get back to 5 times that. What some business owners that we've worked with have had to do is maybe plan for the future. So they've maybe said, well, look, for the next 2 years, we'll maybe get the net profits up to 30. Now, after you've got the mortgage, you can then bring those net profits back down again the following year. What lenders look for now, in the past, they used to ask for 2 years accounts, but I think there was a few dodgy accountants going about. So they now ask for the last 2 years SA 302s and your tax year overview, because that proves what you actually submitted to the HMRC, rather than just getting accounts from a local accountant. So if someone says to me, yeah, look, I'm self-employed, I want to apply for a mortgage, we'll say, well, we need your last 2 years SA 302s and tax year overviews. So again, that's just a wee bit of a heads up of what you might need depending on your situation. Especially during COVID as well, we've had a lot of people contacting us trying to raise money for their business as well. I know a lot of people got those bounce back loans, and I'm not sure if a lot of them were used for business. But some other options that we've done is, obviously, if there's equity in the house, you can release some equity. If you're over 55, some people have been looking at releasing money from old pensions that they had sitting about. Some people wanted to release some investments and savings, so wanted to know what the best options were. We've also done a few equity release schemes. So that's if you're over 50 and you own your own home and you've maybe got a small mortgage on it. There are a lot of people doing this. We're using their parents' house for this. It's usually grandparents that would use equity release, because the older they are, the more money you get. The way it works basically is, so say there's no mortgage on a house and it's worth 100,000, they'll give you 50,000. You don't make any payments. What they do is they take a charge on the house, and then when the house is sold, basically, after both people die in the house or something similar, and you have to sell the house, then they take the 50,000 back plus interest. Again, it did have a bad name years ago, equity release, but we use a guy in Northern Ireland, and he is very good. It's all heavily regulated now as well, so you will know exactly how much money you pay back at the end when the house is sold, so it's all very transparent. Obviously, there's credit unions as well, which we've talked about to a lot of people. So regards insurance for business, obviously, as I said, I'm a financial advisor. So what we do for some companies is a thing called relevant life. Now, it's usually for company directors, but even small companies, if there's only 2 of these and you're just director of a limited company, you can still do this. Where you put the death cover basically in the company's name, and you pay it through the company, but the benefit still goes to the individual. Obviously, the main benefits of that is that the company pay it, and it's not coming out your own personal bank account. Because of that, you save a bit of tax on it as well. It's pretty standard. We set up life cover just as normal. As I said, we put it in the company name. It'll ask who the benefit goes to, and it goes to the individual. So we'll put individual's person's name in there. But it said you can save about 40% on your payments, and obviously it's going through the company as opposed to going through your own personal bank statements. Now, it is only for death cover. You can't do it for critical illness, so it is just a death cover policy. There's also key man insurance, usually for partnerships, where they're worried about if someone dies or someone goes off sick, how are we going to replace that share or that income. So key man insurance is basically for any person in the business who, if they went off or died, it would have a massive impact on the company. So it's designed to pay out a lump sum if that person died to cover their share. It also covers a lot of family businesses or people that maybe 2 or 3 people in a partnership. Whereas if one person dies and the share goes to that family, do the other 2 partners really want that share going to the family, or do they want to pay the family what that share is worth and they keep the share within the group? There's also a thing called group income protection, which pays a percentage of someone's salary if they go off sick, usually up to about 2/3 of their salary. So if you run a business and you've got staff who just go into statutory sick pay as soon as they go off sick, obviously that's not great for them. I'll show you what statutory sick pay does in a minute. But if you can say to an employee, look, if you go off sick, we have a group income protection scheme which will pay a percentage of your salary. Now, you can design the level of it. You can also ask employees to contribute towards it, because it is benefiting them as well as yourself. So that's just some options. Just standard insurance, which is what we talk about for individuals, is basically obviously death cover. Now, a lot of people have death cover. They might have death in service and work as well, which a lot of people forget about. So basically, death cover pays out a tax-free lump sum, obviously, on death. And I think someone asked me before, for death in service, do you actually have to be in service when you die before it pays out? So you can just picture somebody trying to get a taxi because they're having a heart attack to get into work so that the policy pays out. But no, obviously it's called death in service, but it just means if you die during employment. So there's 2 types of main death cover. There's decreasing term assurance, which you might have, which is linked to a mortgage, because the mortgage decreases every month if it's on repayment, and decreasing life cover just matches that. Or there's level term, which stays the same for the full 20 years. Normally that's designed to cover family. Critical illness pays out a tax-free lump sum as soon as you're diagnosed with a serious illness. So, for example, I use my wife as an example. She got diagnosed with breast cancer about 3 years ago. She got diagnosed in the May, and it paid out, I think, the end of June. So irrespective of treatment or anything else, which is why, fun enough, we end up with a caravan down in Newcastle, because the payout we got from that helped towards pay for the caravan, which I was telling Helen has been a godsend for her. Just getting away from Belfast and get down by the sea. And it just makes things a lot easier. If anyone has been diagnosed with a serious illness, you can imagine trying to get through that, never mind at the same time worrying about how you're going to pay the mortgage and stuff. So it just gives you a bit of freedom that you can concentrate on getting well, as opposed to trying to concentrate on being off and paying the bills. Income protection, a bit like group income protection, but obviously you can get an individual income protection plan if your work doesn't do it. You can just sign up for your own income protection plan, which, as I said, covers up to 2/3 your salary, but it pays out a monthly benefit. And it pays out if you're off sick for any reason. You just need a doctor's line, basically. And just going back to some of the tips and hints I give to people, I used to work in Ulster property sales, and our training when we were in there, we were always trained up to maybe offer people death and critical illness first. And if you look at the stats, I think most people take, about 97% of people take death cover. It is very cheap, which is why a lot of people take it. The reason it's cheap, but is very few people die during the term of the mortgage, which is why it's so cheap. It's not very many people claim on it. Critical illness, about 40% of people take it. 25% of people claim on it, so it is a very good policy to have. It used to have a bad name years ago, again, when I started doing it, but they're all heavily regulated now, so as long as you stick to the main insurance companies, you'll get a good policy. They normally cover about 50 conditions. We've got another woman who just claimed on hers. She's a nurse in the Belfast Trust, and she got diagnosed with MS, and hers paid out in full to clear her mortgage that we helped her with. Again, income protection, you have to check with your employer, so it links up with your employer. So again, my wife worked in Queen's, so she was on 6 months full pay. So what you do is you defer the income protection to kick in after the 6 months, but you can change that. So if your work doesn't offer you any sickness, you can get it to kick in straight away, or after 4 weeks or 8 weeks, something like that. So I think like individual insurance, business insurance, you can insure yourself up to the eyeballs. Yeah, as you can see there, that's a lot of the different options of business insurance that you can get. Some of them are actually unknown to me, but as regards your business, something like credit risk insurance, key man insurance, cyber insurance. Some of them you might not have heard about, but they might be something that you think could be useful. And again, a lot of them are relatively cheap as well. Public liability insurance, so a lot of people talk about it, so some people are not really sure exactly what it is. So everybody asks you for public liability insurance, but it's basically just to cover your business in case there's any damage to someone else's property, or someone dies or injured related to your business. It covers any legal costs and any compensation. Again, it's relatively cheap as well, public liability insurance, if you're small. And then once you have employees on board, you'll be asked for employers' liability insurance. And again, this is just to cover any claims regards employees that you have working for the business. Budget planning, we do a lot of work around this. And to be honest, and a lot of the stuff I'll be talking about today is probably a lot of common sense. But when we talk to people why they haven't done it, is because they say, "Oh, I kept meaning to do that," or I had it in the diary, or I just never get round to it. So a lot of what we do is we're trying to urge people to say, look, if anything we've spoke about today, if there's a wee red flag is off in your head, thinking, I kept meaning to do that, then now's the time to stop putting it off. And get something in place. Again, I think a lot of people, when it comes to financial advice, are worried where to go because they're not sure who can they trust for advice. So hopefully us being a social enterprise can tick those boxes for you. But budget planning is another one of those things where people, when we used to do these group sessions, again, if there was a room of 20 and we asked who's done a budget plan in the last 6 months, you'll maybe get one or two that have done it. You usually get some that are quite really good at it, and we get Excel spreadsheets that they update every month. But it's really important just every now and again just to run through what's coming in, what's going out. I'll just give you an example. I was doing it a while ago, just checking on my direct debits, and there was an Amazon Prime coming out my account, and I'd noticed it for a few months. I thought it was something to do with my son with his Xbox. I thought he was signing up for something. And I'd said to my wife, and she says, "Oh, you must have bought something on Amazon and ticked a box for this priority service." And I'd only bought one thing months ago and never used. My wife uses Amazon every day, but I hadn't used it for months. But I was paying this £7.99 for this priority service that I never used. So just things like that. A lot of people we come across when we do this, they'll maybe have 2 or 3 different life cover plans because they've moved house, or they've maybe took some equity out of the house and the advisor maybe given them another policy. So after the years roll by, you end up with 2 or 3 life policies, a lot of them doing the same thing, but maybe on different amounts and different terms. So you can merge them together into one plan usually. So also the case where one woman was paying 2 home insurances because she cancelled the wrong direct debit. It was a legal and general thing. And we've had the opposite where people thought they had home insurance but they'd cancelled it. One girl had phoned us because she contacted, again, it was legal and general, to claim her ceiling came through, there was a bit of flood, and they said, no, you cancelled your home insurance last year, but she actually cancelled again the wrong one. So it's just a matter of time, just sitting going through your bank statements, just making sure you know what every direct debit's for. We also talk about daily spend as well, which is something not a lot of sort of budget planners talk about, which when we looked at it, that's where a lot of your money goes. So, for example, if you take out £10 out of the cash machine and you give it, you buy something at the shop, like newspapers or magazines or can of Coke or something, and you get the kids a couple of things, that tenner's gone. And if you look at that £10 a day, obviously over the week, that's 70. You multiply that over the month, and if there's 2 of these doing that every day, that can be more than your mortgage. That you're basically, and Martin Lewis, the money expert, talks about daily spend quite a lot. He's got a daily spend calculator on his website. The link's down there at the bottom there, 0.8. It's called a demotivator, and we tried it on someone, a girl in Ulster University there a while ago, and she was only spending £4 a day. She got a coffee in the morning and a coffee in the afternoon, 5 days a week. And she put into the calculator, it turns out that was £1,040 she was spending every year just on those 2 coffees, 5 days a week. So again, if you increase that, if you're parents with kids, you can easily be spending £10-20 a day on money that you look back on and you go, where did that go? Again, Martin Lewis has a couple of tips for this, but you have to be really, really disciplined. He suggests maybe getting a different card, either using a credit card or something. You don't be taking money out the bank, just pay everything, all your non-essential stuff on this card, which allows you to do 2 things. It keeps a track of how much you spend each month on that card. You can pay it off with no interest at the end of the month, but you can look back and go, where did I, if there's £400 on that card, where did that money go? And you can look through your account and see where the money was spent. Just another tip as well, especially for business owners. I know I've struggled with this. When you try to do everything yourself, you try to do the social media, you try to do the accounts. You're like many of you've got many hats on. And what I've tried to do recently was just outsource that. So we now use another social enterprise to run our social media, or to help run it anyway. Obviously, we've got accountants as well. The accountant gave us a software system to make using the daily accounts a bit easier. So I would definitely suggest, rather than run around trying to do everything, because even getting the social media away from me doing it, I could sit at night and try and do social media, and now I can sit. I don't need to bother with that anymore. And we only pay them, I think we hire them for a 1 hour per week, which has been great, to be honest, just to get that part away. So debt advice, again, we would work with a lot of organisations around debt. Advice and I are based up in Ormer Road in Belfast. They will actually help you with debt relief orders, IVAs, and company IVAs as well. So again, if you need any of their contact details, and they don't charge either for any of the service. Advice and I are a charity based up in Belfast. So regards some benefits, state benefits, so usually, again, we do these face-to-face, we would ask people how much do they think the weekly state pension is. So again, if you look at your parents, and I wonder how much their pension is, because very few people actually know. And then when we ask people how much do they think the state pension is, usually the answers are very, very, they're a lot lower than what the actual figure is. And this is important for business owners as well. A lot of business owners they ignore their pension. Again, there's probably enough going out without setting up another pension, but it is one of the best ways of planning for the future, pension rules changed there, so you can take your pension from 55, you can take the whole pot if you want, although there's tax implications. So, and again, a pension is what you live on, so we ask people, why do you think that your answer's so low? If you think of it, if you go out for a meal, there's a restaurant down here called Brunel's, and me and the wife were in this last year. It cost us a fortune, but it was the best part of £130 that we spent. Never again. But again, that can be, it's all about expectations when you retire. So, do you want to just sit in the house and have enough to live on because your full state pension will allow you to do that, or do you want to keep in the lifestyle that you've been living in, going on holidays, having cars, mobiles, getting out for drinks? Because you'll not do that on the state pension. So some of the figures at the moment: the full state pension, if you've got 35 years national insurance contributions, is £179.60 per week. Basic state pension, if you don't have your 35 years NICs, is £137. Down there, statutory sick pay. So again, if you go off sick, and the reason I've got that under company benefit, because somebody pulled this up before. I saw a lot of people think statutory sick pay is paid by the government, especially employees. A lot of them think the government pay it because of the name of it, but it's actually paid by the company if an employee goes off sick, but the government tell them the minimum they have to pay that employee. So it's £96.35 per week. So that's why income protection is so important. If you're going from a full salary, you go off sick and you get down to £96 a week, but all the bills keep coming in. That's why people in the Simon community do a lot of work. That's just why a lot of people get into trouble, because if they have a heart attack or something serious, they can't work for months. The mortgage and the rent still coming in. That's how they end up homeless and stuff like that. So that is important that you have something in place. So if you have loads of savings, great. If you have a buy to let that you're going to pay off, whatever it is, brilliant. But if you don't have anything, and we tell people this as well, look into the future. If next year you go off sick for 6 months, are you going to be okay with the mortgage and the rent? If the answer is no, then you need income protection. It's okay having death and critical illness, but they won't pay out if you go off with stress for 6 months, whereas income protection will. Credit cards, we just tell people have a think. I think when I moved over here, I was told to set up a credit union account straight away. But their APR is 12.7. If you go to a bank for a loan, it's at 3%. So just ask them out before you go automatically thinking the credit union's the cheapest place for a loan. It might not be. There are new benefits available to people as well, either after COVID or during COVID. Tax credit limits have changed and that sort of thing. A lot of people are unsure what benefits they're entitled to now. So there's a couple of options there. One of them is called Entitled To, which is obviously, as the name suggests, if you complete that, it'll tell you all the benefits that you're entitled to, given your current circumstances. We also provide a financial wellbeing score, which will ask you questions such as, if you were diagnosed with cancer, how concerned would you be about paying the bills if you had to stop work? And if the answer is I would be concerned because I've got nothing in the bank, then that's obviously a red flag. So again, people can email us and we can send them this out. There's about 10 questions on there. It will then calculate your score to say, like, your financial wellbeing score is 30%. These are the areas that you need to look at. So it'll be things like, do you have an emergency fund? Do you have a pension in place? All those sort of things. Just conscious of time here, so there's only a few slides left. Regards mortgages, so as I said, I'm the mortgage advisor, but we do the exact same service as any other mortgage broker in Northern Ireland. Obviously, the big difference is we don't charge for the advice because of those reasons I've stated at the start there. But we do a lot of planning with young people as well about how to plan to get a mortgage in the future. We also do a lot of co-ownership stuff. Co-ownership gets a bad name over here, but it's actually a really good scheme. I've got on there 100% mortgage options. Apart from co-ownership, there aren't really any 100% mortgage options. Well, that's your only one. 95% mortgages did come back there, so they're back on the market. But that's all the areas we cover under mortgages. Just one bit of advice there as well is, again, when I was in training, we was always encouraged people to take 2-year deals all the time, because if you think about your self-employed mortgage advisor, if you've got 300 clients If they're all on 2-year deals, they're coming back to you every 2 years. So you do be doing the mortgage, which you're earning commission from, and you might be doing the insurance as well. Just a wee tip on the insurance: when I was self-employed, if I had done a £50 a month policy for someone for death and critical illness, we got an average 20 times that. So I would get about £1,000 for the life insurance. For a £100,000 mortgage, you get about 0.3, 0.4%. So you're talking about £300, £400 for actually doing the mortgage. So if you're getting 3 times for the life insurance that you do for the mortgage, you can maybe understand why a lot of advisors would be pushing a life cover to you when you go to do a mortgage. The thing with income protection is that it's classed as home insurance, or it's classed as general insurance, the same as home insurance. So we would only get about £50 for an income protection plan, where you would get £1,000 for life insurance for death and critical illness. But when we look at it, a lot of the way people normally take it is they'll take death cover, then they'll take a bit of critical illness. They normally don't take income protection. I think only 6% of people actually take income protection, and it might be a coincidence that that's what you get the least commission for. So again, when we look at most people's situation, it's usually the other way around. Actually, you should be looking at income protection first, because that pays out for any reason and it pays your bills every month. Especially if you're single, you don't need death cover, do you? So then your next stage should be critical illness, and then if there's any money left over, then yeah, death cover after that. So again, that's not for everybody. If you're married with kids, it could be death cover first. So everyone is different. All we're saying is just make sure the plans you have in place suit your circumstances at the time. Credit scores. So again, what makes a good score and a bad score? I'll email all these slides again to Helen so you have them, but they're changing all the time as well. We recently had someone who was declined for a mortgage. Now they had 7 credit cards, nothing on them, never missed a payment, but the lender had said that was too much of a risk, because if they decided to use all the money on those 7 cars, they could rack up about 30,000 a debt, and the lender said that was a risk. So they were asked to close some of the cards. What some people do is then close all the old ones, which again, Martin Lewis says don't do that. Because if you close all the old ones, it looks like you've opened up 2 or 3 cards in the last year, and lenders will say, why are they doing this? So what you do is you close all the new ones and keep the oldest ones, so it looks like you've got 2 credit cards that you've had for 5 or 6 years. And again, anything on your credit score stays on there for 6 months. So even for a mortgage, if you miss a payment on something, if it's within the last 3 months, you'll be automatically declined. So it is important you keep a good eye on your credit score. Pensions. Now we don't really get involved with employee company pensions. You'll have your own pension provider. Most of the help we with are people with maybe 2 or 3 pensions. Do they merge them? Do they keep them separate? Or people nearing retirement? What do they do? Do they take the lump sum? If they take the lump sum, what do they do with it? Again, it's one Simon always talks about. It's the biggest saving scheme you can earn. For every 80 pence you put into a pension scheme, if you're basically a taxpayer, the government's put in 20%. If you're a higher rate, obviously you can see the difference there. Sometimes your employer contributes as well, so it's an absolute no-brainer. What people continue to do is continually put it off. And then people get into their 40s and then they kick themselves that they never started it when they were in their 20s. So that's where we would give a lot of advice. And again, especially for business owners, that is definitely an area where people tend to ignore. Again, you're sort of putting it off, sort of thing. You know you should have one, but you just keep putting it off. So we advise everybody, like, don't put it off. Even start off with a small pension monthly pot that you can just build it up as you go along, because I said it is the best saving scheme out there. We also run a couple of other sessions. We do these for the Education Authority. We run a preparing for retirement session, because they were getting staff who worked all their life, suddenly they retire, and then they're looking around to what they're going to do next. And it can be a big mental health issue as well for people who, as I said, their whole life evolved around work, and then suddenly it's not there. So we try and help people plan. We actually work with a counselling psychologist who delivers a session for us on the mental side of retirement. But she also does, we recently ran a financial and mental first aid session, just around how finances affect you mentally. So we run another couple of sessions on that. There's also a thing called AVCs, which if anybody's interested, and additional voluntary contributions, which if you're working you can pay additional pension scheme providers. So that's my contact details. As I said, the office is open back up again. We're in Duncairn Gardens in North Belfast. We're not in the office a lot, so you're probably easier just getting me on the mobile. If anyone does need one-to-one advice, or you want us to come and do a talk to your staff or anything, because of Enterprise NI, there is a discount there for any company who is interested. If you want a budget planner, we have an Excel budget planner on our website, which is free to download. And we also have a coronavirus financial newsletter, which you can download again free of charge.